Welcome to Trading Strategies for October. You know, the markets rose last month, bucking the trend. So do we get some sort of a pullback in October? Well, the market may not be as forgiving as everyone thinks, but we have you covered over the next hour with an all-star panel. Let's welcome back Stephen Sarge Guilfoyle, a former NYSE trader, and he's behind TheStreet's Stocks Under $10 portfolio. We also have David Yo Williams, who is a commodities and gold expert. He's also a principal at Strategic Gold. And Peter Scher is a fixed income expert and managing director of Breen Capital. He's also heading up TheStreet's new fixed income product, Income Seeker. And Douglas Borthwick is the head of foreign exchange at Chapdelaine. And guys, welcome back to everyone once again. You know, I started off last month's panel by saying that September is historically the worst month of the year for the markets, with the S&P 500 losing an average of 0.7% since 1945 every September. But yet, the S&P 500 rose 1.7% just this past month in September. What happened? Stocks bucking the trend. Sarge, we'll start with you.
Well, we saw hope regarding a tax plan. We saw hawkish talk from a bewildered Fed chair, which led to the financials moving on higher. Most of this move for September actually happened late in the month, if you look at it. And plus, we had the forward movement of the small caps and the transports. Basically, it was a pretty good month. And now as we roll into earnings season and the ECB meeting at the end of this month, I think you might see a chance to move sideways or maybe even a little pullback, but I still see upward forward movement for the whole quarter.
David, last time around, you were warning of an impending crash, and here we are, stocks bucking the trend with a great September here.
September was very good, and it did buck the trend, but the trend also says in October, for the last 60 years or so, 2/3 of Octobers are positive and 1/3 are negative, and the 1/3 of the negative is usually very mild unless you hit the big number of October crashes, which have happened 4 or 5 times, 2008 being the latest. So I still am very, very leery and bearish because it kind of sets up, September being a good month kind of sets up for October not being such a good month.
So you think that inevitable pullback is coming in October?
I do.
That's the month.
I do.
Peter, do you agree with that?
Again, I'm stuck in this mode where I think the steady pace is slow grind higher with a chance of more of a market structure pullback where something goes on, whether it's in the VIX or vol space or something else that drags it down. So I think you continue to have to be long risk. I'm a little bit more worried about treasuries now, but I also think you need tail hedges because there is that potential, and I think it's increasing. The longer we go without a big pullback, I think the more likely it becomes. So you want that tail risk, but you don't want to be overly bearish.
Can we define pullback? Because so far this year, it's been, what, 1% to the downside in the S&P 500, and that, of course, has proved to be a buying the dip strategy. What is pullback in your view?
For me, I think 5 to 10%.
And that's possible in October?
I think so. I do believe that we're set up in such a way that you've got all these interrelated products, all these interrelated markets, that if we get something, it will snowball fairly quickly. Probably the likely scenario is you'll get one of these down 1% that people try and buy. That fails, maybe get another 1% down that people try and buy, and that flushes out a lot of the buy the dip crowd. I think that's how it's going to happen, is that buy the dip doesn't work once or twice, and that creates some selling pressure.
Doug, what do you think? How do you grapple with the rising stocks in September when everyone said it was not going to be a good month?
I think that rising stocks surprises me somewhat. I think that the hurricane added to that because of the idea that a broken window, once getting fixed, is going to be good for the economy. I think that what's really interesting is that the dollar moved sideways over the course of the month and the stocks still continue to rise higher. I think that what's going to continue this rise higher, and I'm not looking for a correction in October, I think it'll continue to rise higher because I think that Trump's going to bring out Powell from the wings, talk about him being the new Fed chair, and if that's the case, I think that's going to be very dovish for the dollar. It should be very good for stock market, especially given his regulation stance.
We're going to talk about the Federal Reserve and the makeup of the Fed in just a moment. But, you know, we had Warren Buffett on CNBC this morning basically saying that stock market valuations, where they are right now, make sense given how low interest rates are. He said that before. Sarge, do you agree with a statement like that?
I couldn't agree more. Forward-looking valuations are only about 19 times. That's not crazy. It's well within the normal range. Maybe it's a little above average, but we're not talking about 25, 26. We're talking about 19. And if you look at the sectors, there are many names still trading at 13, 14 times earnings. You can still find value. I don't see the panic everyone else sees.
David, though, I can't imagine you agree.
I don't agree, and first I'd like to disagree with the Sarge. the panic that everyone else sees, there's no panic out there. The markets are going up. We've had 5 straight days up in the equity markets. Bonds are stable. There's no panic out there. If anything, there's complacency. The VIX is below 10. I think 9 something, whatever.
By panic, I meant the naysayers.
Okay, so the naysayers are guys like me that you talk to because we've been friends forever. In the actual marketplace, the naysayers are almost non-existent, I believe, and that becomes the issue. We're also going to talk later on about 1987 or 2008, some of the other crashes. There are things that are eerily similar to those periods of history as to now. And for Mr. Buffett to come out and say, okay, stocks are fairly priced, versus interest rates or versus, that can all change in a nanosecond. And when it does, all of a sudden valuations change. So
yeah, but earnings growth, I mean, that is shaping up, and we're going to get more earnings next week. That's likely going to be another good quarter. We had 2 straight quarters of double-digit year-over-year increases in earnings. Couldn't earnings growth prevent an October correction?
Absolutely, it can. I mean, so what I'm talking about is an event that it doesn't have. Obviously, it doesn't happen very often, and so there's all sorts of things that can prevent it, including earnings growth, the Federal Reserve, interest rate moves. But I believe that the factors that are lining up point towards some sort of a major correction coming up.
But Peter, weigh in on your outlook for earnings, because we get the big banks next week.
I think earnings will be okay. I look at this again, that I see fundamentals okay. There's some overvalued, some undervalued. I'm more about a structural issue that would be a quick downfall, but also I think we start looking at what sectors have become overvalued versus undervalued. I think right now, the recent rise in the Russell 2000 may put that a little bit overvalued or stretched. I think some people are making a mistake on the tax plan, what that means for big tech, so I'd probably be moving out of big tech. And I'd look for some of these smaller high yield companies that are still languishing or way behind multi-year highs as a place to put some money.
And Doug, obviously you're watching currencies when it comes to earnings season. Give us your outlook on earnings through the lens of currencies.
A couple of things. First, when Buffett talks about low interest rates good for stocks, we have to remember why are interest rates low, and they're low because of extreme intervention by central banks. So if you take that away, interest rates would rise, stocks would then come off. Why are earnings higher? Earnings are higher because, as we can show, if the dollar weakens by 1%, S&P earnings go up by 0.5%. So the dollar's been quite weak since the start of the year, from 104 against the euro to 117.80 right now. That sort of move is going to help add to that double-digit growth in earnings, and it's not because they're selling more, it's because they're getting more in.
Sarge, you have an article up on TheStreet.com right now about stocks you like for October. What tech stocks are you fond of for this month?
Oh, I still love Intel. I still love Lam Research. Those are 2 of my long-term favorites. I know the article says I sold NVIDIA, and I did. That was strictly,
could you do that?
Because I'm a trader. and I took a nice profit in NVIDIA. I still like the stock, but it's been hitting consistent resistance up here in the high 170s, around 180, and I think I can buy it back at 170. Now, if it breaks through that resistance level, I'm going to jump back on board, even though that would be above where I sold it. I'm just trying to make a little money on a trade.
You're also short Tesla, which is now in correction territory, down 11% since its September 18th peak.
I knew I'd be right if I stayed short forever.
Well, what do you make of Tesla?
Okay, I just don't. What did they produce? About 1/6 of the vehicles they were supposed to produce.
That was a rough report.
And they're wrong almost always on their models. So the only thing Tesla is good at is raising money. That's it. I don't think Tesla is very good at anything else. I mean, I guess they make a nice car. The people that own the cars do say they like them. But looking at this from a trader, I think it's still a short. I will buy this tranche back at 290 if it gets there. I'm not going to hold out for 100 points or anything. But I do believe it can get to 290 and I'll cover it.
And Tesla is one of Real Money's 10 hated stocks for October. So everyone can go to realmoney.com to find the rest of the stocks that our team hates. David, what do you make of Tesla? Is this a stock you would avoid completely?
I absolutely would avoid it. A lot of these stocks, like Tesla, that have had huge run-ups over the past 3 to 6 months, any FANG stock, I think that they're hugely overvalued, and so I don't see where you're getting the value from, and so those are the kind of stocks that, if you're talking about a market correction that I'm talking about, those are the ones that it can easily start there and snowball into something bigger because people have lots of profits in them. If they start losing their profits there, it goes into other places, and they try to
Peter, could Tesla start a market correction?
I don't think so. I don't think it's it's too much of a cult stock, I think. It's not as widespread. I think it's going to have
the FANG stocks.
The FANGs, though, I do think, right? That's where people care about. Facebook, Apple. Right. If those start showing weakness, I think that would have a very big impact on the broad market because there's a lot of money, profits that are booked in there. If you start seeing selling pressure consistently in there, then we have bigger problems. So far, the 2 times in the last month the FANG has started to sell off, you've had a rotation either into FINs or most recently energy or the Russell 2000, so it's protected the market from that sell-off, but that's what I keep watching for is pressure in the FANG that leads to broader pressure.
Well, you know, with Facebook, obviously I think most of us can agree, great company, great business model, good ad prospects, but out of nowhere you have these headwinds from Congress slamming Facebook over those Russia ads. I mean, this is something that's not going away. As an investor, you have to wonder what's next on this front with Facebook.
Yeah, I wrote this morning that I'm staying out of the gun stocks for political reasons. Not that I have a political view that would keep me out of the gun stocks, but that I think it's too volatile due to the political climate. Well, the same with Facebook. I think Facebook right now is a political hot potato. To his point on FANG, to Dave's point on FANG, I'm almost completely out of FANG, and Facebook is part of FANG, so I'm out of it for other reasons, but for political reasons, I would just stay away from this. There's going to be trouble. Both sides of the aisle are going to hate on Facebook.
David, do you agree with that?
I do, and I'm happy to finally agree with Steve on something. I think that to stay out of those, you know, any kind of company that becomes embroiled in politics, and whether it's a useful or a worthwhile problem or not, or you know whether it's legitimate or not, is almost immaterial. It just becomes feeding on itself, and as an investor, you're better off waiting and staying away from it for a while.
Let me ask a broader question about investing. Can you own a stock if the company is great, say Pepsi, for example, even though the group, the consumer packaged goods group, is not that great? This is actually something that Jim Cramer and I spoke about this morning, and he was curious about everyone's thoughts on that concept.
You certainly could if you like the company enough. I'm trying to think if I own any consumer packaged goods right now. I got rid of my Coca-Cola about 6 weeks ago. I'm not in Pepsi. I don't think my book right now includes any stocks like that, but I could certainly see the case if you had a stock that you thought was destined for outperformance.
Yeah, I mean, Peter, this relates to fixed income, right? The best house on a bad block kind of mentality.
I tend to like to be a contrarian, so I would actually be scouring my world for stocks that people don't own. You know, I would do it, you know, if there's new ETFs launching in a space every week, I'd be getting out of those stocks because that's probably a real sign that, hey, this is very overcrowded. People are trying to tap into that last dollar of investment. Those are the stocks that tend to fall quicker, I think. You look for the value, you look for stock. You might have to wait, you're going to have to be patient, so it may not fit a trading strategy. But if you've got a 6-month to 12-month horizon, I think there's a lot of companies, particularly smaller high-yield companies that have been ignored for a while, that can still do well. We liked energy for the last while. I actually am not opposed to owning some of the retailers here. I think the retailers...
Which ones?
I would go for a basket. I'm not willing to make a decision because I think there is so much pressure coming from Amazon on down that some will continue to fail like we had toys. At the same time, there is going to be a regrouping. They're going to rethink their business model. They're going to come back. And I think you'll be surprised at these valuations and the level of short interest, how quickly things like XRT, which is a retailer ETF, can bounce.
Let's talk about a couple of things that have occurred since our last roundtable. Most notably, the Federal Reserve announced at its September meeting that they will start to unwind that balance sheet this month. We've talked about it. Many of you agree there's not much of an impact for the markets, but just sort of bring us up to speed on how investors should be parsing this process that the Fed has never done before. Doug, we'll start with you.
Well, I think that the statement that they're going to start reducing the balance sheet this month is maybe a little bit off field, in that they're going to certainly start tapering how much they're reinvesting in the market. But it's not until really April of next year that they start biting into it based upon the timetable they have of the reduction of buybacks. So based off of that, by April of next year, you're going to have a completely new Fed in power, and the odds are that Yellen won't be there and Powell will. So I think that what they've done is they've rolled it out until really March of next year before real decisions can be made. And in the meantime, the rollout they've made is gradual enough such that the market's not going to get too panicky.
I want to come back to the makeup of the Fed, but Sarge, weigh in on the balance sheet in terms of how you're watching it as a trader.
I think it's the right thing to do. I think they're actually late on this, but it's time to get the ball rolling. I don't have a problem with it. Where I'm going to have a problem is when they try to raise the Fed funds rate in December. with a Fed chair who tells you that she doesn't understand consumer level inflation, that she doesn't understand the failure of the Phillips curve.
She calls it mysterious
Right.
how low inflation is.
You know, I've known guys who've been in sandstorms and their radio goes out. You know what they do? They stop moving. All right? They don't say, let's go, we got to go, and they don't do that. They don't stay on schedule if they get into a position where they can't see where they're going. And she admits she can't see where she's going. Now, her becoming a sudden hawk makes me wonder if suddenly she fell out of favor with President Donald Trump, and now she knows she doesn't have the job. That's where I go with that, and that leads to Douglas's idea.
Let's go to Kevin Warsh. I mean, he's certainly not a.
He's also a hawk.
Not a dove.
No,
so,
he's a hawk.
Right.
I don't think he's the front runner. I agree 100% that Jerome Powell is the front runner.
You think Jerome Powell has a more similar view to Yellen, but why not just keep Yellen then?
Well, I don't know what goes on behind closed doors. Maybe they never liked each other. I mean, she's pretty good about keeping her mouth shut when it comes to interpersonal relationships. The president isn't, but she is, and maybe he doesn't. Maybe he's not going to embarrass her on the way out. Maybe this is all in my head, but I see Jerome Powell as a regulation guy, as a Republican when almost everybody else at the Fed is a Democrat. I see him as having a leg up for the job.
So to Doug's point, I mean, would Kevin Warsh, if he was nominated, would that cause stocks to cave in? I mean, would that
I
sort
think
of seal this wall of worry?
I don't know if anything seals the wall of worry, but I think it's fascinating because if you go back in history, in 1987, Alan Greenspan had just become the head of the Fed in August, and the crashes in October. He had not raised interest rates yet, but he was talking about it. So we had a 4 or 5 year run up in stocks. They were up, I don't know, 300%, something like that. At the time, we were in a euphoric state, and all of a sudden things were changing. He was talking about getting tighter money, raising rates. We had new people in charge. Things were changing, and stocks got very worried, and it created a bit of a panic. So consequently, they flooded the system with liquidity. Greenspan did, and we've been on that run since 1987 until now. So the interesting part to me is to say, okay, if things are changing, if President Trump is in, the Fed is changing, things are changing. They're talking about, regardless of who's in charge, they're talking about raising rates. They're talking about ending QE. Draghi is in Europe. He's not talking about raising rates yet, but he's talking about ending QE, tapering. That is not giving liquidity to the marketplaces that we've become addicted to for the last 5 years.
Peter, when Kevin Warsh says the Fed's strategy needs a quote fundamental rethinking, I mean that can't be good for the markets.
I have two things on that. One is I don't remember Yellen being the ultra dove before she took the seat. So I think the second that it's very easy to be hawkish and talk all hawkish, and once you get that seat, you probably shift 4 spaces to the more dovish. Right? It's very easy to talk hawkish. So I'm going to do this, I'm going to do that, I'm going to hike rates. I think the reality is once you get that seat, it forces you to be more dovish than you would ever expect. But I think one thing, following up with Dave's, I think the single most important people could do for their thing they could do for their portfolio right now is look at where they're borrowing. Look at your home equity, look at your mortgage. If you're borrowing floating rate, if you're borrowing against LIBOR, if you haven't locked in, I think now is a great time to refi, because not only do you have a hawkish Fed affecting the short term, you've got this balance sheet reduction, which is also hitting the mortgage space. And we all talk probably much more about the balance sheet reduction on the Treasury side. There was a time last year when the Fed was buying 80% of all new production mortgages. So basically 4 out of 5 mortgages that were being created were being bought by the Fed. That will go down fairly quickly to 20%. So all of a sudden you're taking a buyer who's a little bit indiscriminate on pricing out of that market. I think you're going to see mortgage rates go higher. You're going to see yields go higher. So the first, and in this day and age, it takes 30 to 60 days to get a mortgage done. I would sit back, see where you're borrowing, and see how you can address that. And if you can lock in lower rates today, that's what I'd be doing. Think about what all the big corporations are doing, the Apples, the Amazons of the world. You should be doing the same thing on your personal side. I know we talk mostly about the balance sheet side of the equation. Your liability side of the equation is very important too, and right now I would lock in rates. In fact, I'm closing on my mortgage tomorrow, a refi.
There you go. Well, yeah, I think investors are sort of overlooking the importance of who's running the Fed and the fact that there are so many vacancies. I did want to ask you all, because Trump loves tweeting about the stock market. He does it almost on a weekly basis, and perhaps that's also because he's had no real legislative wins, so this is something he likes to tout. Wouldn't it be beneficial for Trump to keep a dove running the Fed so the markets can keep grinding higher here?
Of course. And that would also keep the dollar cheaper, which is paramount to the forward movement of the economy from a macro perspective.
So then what's with this Kevin Warsh? I still can't wrap my arms around why he would want someone like that in office.
Well, I don't think he does.
Well, he reportedly met with him.
Yeah, he met with a lot of people for Secretary of State that never got the job as well, and I think he's well known for interviewing lots of different folks, making it look like this is a very broad interpretation. Also, if he brought Warsh in, remember, he's also like, that's the son-in-law of one of his best friends.
Right.
So, and you can't have too much chumminess in the White House these days, given how the media is going around. I think that he's got to meet with them. He has to talk to him. He's got to take a lot of different folks, take their temperature. But the reality is, Powell seems to be the one that's going to help with the deregulation. And when you talk about the Fed disappearing from buying mortgages in the market, that means the banks have to step in, and that means the relaxation of the VOCA rule. And Powell, just the last couple of days, has been very vocal about how he'd like to work on doing that. And he's very vocal about deregulation. And he seems to be the guy for the job.
So is Powell better than Yellen?
I think so. I think it's a fresh face. It's someone that maybe is a Republican for Trump, so that's in his mind that's good, and it's a fresh change.
This is, though, very typical of Trump, this sort of apprentice-like guessing game of who's going to be the next Fed chair, because you did say last week that a decision is coming in the next 2 to 3 weeks, and I actually wrote an op-ed about this on TheStreet.com. Janet Yellen was nominated by former President Obama on October 9th of 2013, Bernanke on October 24th of 2005 by former President Bush. So Trump is running out of time to make a decision. This is not an easy job to fill. It requires Senate confirmation. Speak to his his love for this mysterious kind of, leaving everyone out in the cold as to what decision he's going to make.
Oh, you're not entertained? Right. I mean,
but as an investor.
Well, as an investor, of course you have to pay attention. Of course you have to wonder. And of course, Powell and even Yellen are probably preferable to the other choices, to Warsh or to whoever might be a little more hawkish than they are, and which is why I think she might be a little bit out of favor right now because of the way she has spoken. Yeah, I mean, I know it's artificial. I know it's the punch bowl, but lower rates obviously produce better numbers, at least in the short term, and that's what we want. This president might not even be a two-term president. He might not want a second term. I don't think he's enjoying the job. I think he was comfortable before. He's not comfortable now. I think he's got a 2.5-year window, not a 6-year window.
David?
So we're spending a lot of time discussing this as investors, and I get where you're going with these questions, and it makes sense. But I think what happens is it's like, here, watch the hand, and what's really going on is behind the scenes. If we're all focused on who's going to be the next Fed, who's going to fill the 4 slots that are open, or the 5 slots, whatever it is they're open, and as he's filling these slots, that's all well and good. When's he going to fill them? Who's he talking to? That keeps the narrative going in a certain direction. In the meantime, you have all sorts of things happening outside that narrative that probably are much more important and are going to impact the Fed and other central banks as much or more as who's running it. For instance, we were talking about what causes a market debacle in 2008. It was mortgages. You're just saying, okay, and I agree with you 100%, Pete. People should not just look at one side of the ledger. Look at the other side. Look at your liabilities. Look at whatever, because that impacts individuals and how they trade. You shouldn't just look at your assets or whatever. That goes for countries too. Just last month, China is finalizing a deal with Saudi Arabia to trade for oil. China is the largest importer of oil in the world. Saudi Arabia is the largest exporter. China is going to trade oil for yuan. Oil is traded for dollars. Petrodollars have been the staple since the 1980s. As this goes through, supposedly it's going to happen before the end of the year. As this deal goes through on a bilateral agreement, the Chinese said, we're going to trade oil for yuan, and the Saudis say, we don't want your yuan. Why don't we just keep dollars? And they say, because you can go to the Shanghai exchange and you can change those yuan for gold. So they're going to basically they're backing their yuan with something. Now, it's a floating rate. The Shanghai exchange is a gold exchange, and so the rate's can move up or down depending on the buys or sells versus the yuan. If that occurs, that's a lot of dollars that don't need to be out there anymore globally. At the same time, you have Putin, who's now been involved with China, that he has more gold than he's had ever in the entire time he's been involved, and I think they've been buying gold for 4 or 5 years now, just like the Chinese. And as they make their bilateral agreements, it seems as though, I think it's very obvious
Yeah.
that they're moving away from the dollar.
Right.
The Europeans tried to move away from the dollar in the late 80s and the 90s.
Yeah.
This is a huge shift.
I'm glad you brought up China. I wanted to ask you all about China in the context of the Fed's balance sheet, because we know, obviously, China owns a very large portion of U.S. Treasuries. China's debt to GDP at now 268%, that ratio, compared to about 150% 10 years ago. We know S&P downgraded their credit rating, which happened since our last roundtable. Any impact here, the Fed, China? Can you link those two?
Well, I think that for China, the percentage of debt to GDP is largely irrelevant, given that it's such a major power. Certainly, we don't question the debt to GDP ratio of Japan, which I'm quite sure is a lot worse. I think that with China as well, when you look at bad debt, it's not a free democratic system. You know, the central bank can come in and take over banks. They can smooth over things that maybe can't be done in the United States. Although the United States did a very good job smoothing over the things back in 2000. So I think that, you know, I'm not really that worried about China and the size of their balance sheet or the debt that's outstanding. One thing that China does have is they have a lot of U.S. Treasuries.
Right.
And they're also entering into a number of deals where they want to have, let's say, the bauxite in Guinea, and they say, you know what, we'll lend you $20 billion, so just take it from our Treasury balance sheet, we'll just switch that over to you, and in return, we'll get the bauxite out of your country. And for me, I've been thinking, well, that's a great way for them to reduce their dollar exposure, but at the same time increase their commodity exposure. And it's not just Guinea. There's a lot of countries around the world that China's going in and doing 10 billion here, 50 billion there. After a while, it starts adding up to $1 trillion. And I think that what they're doing is they're doing dollar for commodity swaps pretty much all around the world. And it's just a great way to get rid of that big treasury balance that they have. Certainly, who's going to get hurt if the Fed was to raise rates aggressively? Well, the Chinese would get hurt, the Saudis would get hurt, the Japanese would get hurt, and the Fed would get hurt because they're a big holder of U.S. Treasuries too.
Right.
Now, all of these folks are folks that we want to keep happy. So I think it's very unlikely we're going to be raising rates anytime soon, very aggressively. But I do think there is certainly, as David has attested, there's certainly a move away from the dollar. And it's not just China and Saudi Arabia having that discussion. They're having the same discussion with Venezuela, taking Venezuelan oil and just converting that into yuan. There's also discussions, you know, pretty much every oil-producing nation is now having these discussions.
Right.
And I think that that's really important, because we talk about the petrodollar propping up the U.S. dollar. This is now, you know, moving away and becoming less of an important to the U.S. dollar's value. And if there is less demand for dollar, but the supply remains the same, the dollar weakens.
Peter?
Right.
Yeah, I do think the likelihood of a negative surprise coming out of China is relatively large. If we're going to get surprised by something, it probably
You said
comes out of China.
relatively
Large. So there's a risk of that happening. And partly, too, we get stuck in this world where our news cycle now is nonstop, right? There is, between the hurricanes, the tweeting. So I think,
Who's tweeting?
things that we would normally pay attention to in China get dusted off a little bit because they're not occurring during our news cycle. And with our news cycle so busy, it's easier to ignore that or just them to get misplaced. And then you put in the level of opacity where you really can't tell what's going on very easily. So I think the likelihood of a surprise at some point where something bubbles up in China, and I think it was a month and a half ago, they changed some of the reserve requirements. Some people say it's a big deal, some people say it's not. But it all kind of got brushed away. So it's probably the sort of thing when we'll get a slow news cycle and I'm going to start poking around, ooh, what's going on there? And it'll either impact treasuries or some other market that it should have, but is not because of, you know, the craziness that's DC right now.
Ray Dalio of the world's biggest hedge fund, I interviewed him a couple weeks ago. He's reportedly starting a new China fund. He told me he's not worried about China's rising debt levels. He says we have debt here in the U.S. too. So what does that tell you about just China as an investment?
Yeah, I think it's interesting. I personally prefer Japan right now to China. I think
Japan has an election coming. That could be a curveball.
Yeah, so I probably have to be careful ahead of that. But
The governor of Tokyo is running for
it took them,
potentially.
yeah, but it's taken them 20 years. But I think they're, you know, I saw for the first time actually they've created net new full-time jobs. It took 20 some odd years for them to turn this around.
I would like to go to that point, and this goes to being old, like Stephen here. We were talking about the crash in 1987. Fine, you know, certain things led up to it and occurred. And we can talk about it, you know, as you go on. In 1989, throughout the 80s, Japan was the model economy. They were rivaling the U.S. They were the model economy. We should all copy Japan. And I remember vividly, the Japanese were coming over here, spending their money, blah, blah, blah. In 1989, their market crashed. Their market at that time, the Nikkei, was at 39,000. It crashed. I don't know what the low was. I know it was easily down to 14,000. Now it's at 20,000. We're talking about some almost 30 years later, it's only got half back of what it was. Half. So we're talking about what's happened in our market since 2008 and how much it's expanded. If in fact there is some sort of a blip in it, everyone says buy the dips because it's always going to expand since 1987. The reason for that is because since 1987, the Fed, the government, has added liquidity to the system through the banks, whatever, and every time there's been a blip, it's stopped it, and we've moved on from there. So you have the Bernanke put, the Greenspan put we've talked about. Well, the Japanese have been one half in the Nikkei since 1989. They've only got half of it back. If that happens in our market, buy the dip doesn't work 20 years later or 30 years later when you're still 50%.
The Corona put?
Yeah. So, I mean, everyone thinks that, stocks go up no matter what. That's what we're taught since we're infants. Scott, you know, stocks go up.
Stocks go up.
So
Dow
buy
100,000.
stocks. Yeah, buy stocks. That is not the case. I'm throwing it out there.
Yeah.
Doug, go.
I think you're onto something. I think you're onto something. And remember, the Japanese have been throwing money after the Nikkei from day one.
They've had excessive debt.
They don't really discuss, oh no, we're at 100% debt to GDP, 200%, 300%.
Right.
They don't care. They
But
just
the
keep
Fed
on
has
buying.
sort of been doing that to the S&P 500.
Well, to an extent, yes, but the Japanese are doing it directly. They're buying the ETFs.
Buying equities,
right? And the Fed hasn't started buying equities yet. Maybe they will,
right.
but they haven't yet.
While we're talking about global central banks, David, you mentioned the ECB earlier. Obviously, we have a critical meeting for the ECB coming up in a few weeks. It could be the second major central bank within a 6-week span or so to announce a pullback of stimulus. What would that mean for the markets, and do you expect that to happen?
I don't expect it to happen, and I think it would be detrimental to the markets, and that's why I don't think it'll happen, because I think that they want to do it. They want to get back to normalcy because they want to tell everybody we're at normalcy, but they can't. It's to Doug's point that you have to keep interest rates low. You have to keep feeding the beast, because if you don't feed the beast starves, and the beast is going to get really angry, and we're going to see a problem. And so I think that they have to keep doing it. So when Draghi talks about limiting, he's not talking about raising interest rates. He's talking about limiting QE. Well, right now they're still pumping money in. They are actively involved in QE, and he's saying, okay, we're going to reduce the amount we're pumping into, not take away. Reduce the amount we're pumping into. I don't think they're going to be able to do that.
Well, if I could just add,
sure.
Yeah, there's one thing that we have to look at, and that's when Spanish interest rates or Italian interest rates are lower than U.S. 10 years. That's a problem. And I think that the ECB realizes that there's a problem here. Either the U.S. is doing a lot worse than we expect because they're doing as badly as Italy, or Italy's the interest yield in Italy is maybe too low. And I think that the ECB does have to model it somewhat, because right now it just seems like interest rates are completely off par when it comes down to all across the curve in Europe. And I think the ECB has to do something that pushes up interest rates just a little bit in some countries, because right now they don't make sense.
And Peter, in your article up right now on TheStreet.com, you actually like the Eurozone financial sector. Explain the opportunities there.
I think we're finally getting the economic growth where you'll see some of this replacement. I think we saw it in the US where it takes years before people start getting comfortable to really replace things. So I think you're going to see increased growth. I think you're going to see a more favorable yield curve to the banks. I think the banks could use a slightly higher rates across the board. I mean, credit spreads in Europe are even tighter there. I think, I'd have to double check, IHYG, which is a European high yield ETF, was yielding less than the long bond at one point. So they actually could use higher rates. I think they are not as exposed to currency rising at the bank level.
Yeah. The Eurozone, obviously there's all this inter-European trade, and 20% of it comes out and goes into the US. So where the euro-dollar rate goes is largely irrelevant to European industry. And the ZOO survey says that about Germany. They're not really getting affected by what's happening. It doesn't seem that there's any confidence that's changing within the German industrial system regarding where the euro is going. Europe right now hasn't made any discussion about, and the ECB hasn't made any discussion about the euro other than volatility.
Right.
They haven't talked about it being too high.
Yeah.
They haven't talked about it being too low. They just talk about volatility. Every central banker likes to know that the pace is going to be gradual.
Yeah, Mario Draghi learned his lesson from that volatility he sparked in late June.
I do want to move on. Gift, I think. Is the movement of the dollar. I think they looked at it as a gift. And I like your idea on the European banks. I actually got myself long the ETF EUFN, which is the financial sector in Europe. And I do believe that when they do start pulling back on quantitative easing, I think they will go down to 40 billion euros a month. I think we'll see a little
All
movement
right,
there.
we'll watch how it plays out. I want to move on to another development that has occurred since our last roundtable. We got more details on President Trump's tax reform bill, eliminate the estate and alternative minimum tax. That, of course, benefits the wealthy. Move the corporate tax rate to 20% from 35%. And here's an interesting stat from Goldman Sachs' David Kostin. Every percentage point fall in the corporate tax rate actually adds $1 to expected S&P 500 earnings per share. Sarge, is this getting overlooked?
No, that's actually true. It's that's spot on. That we will see, if we do see the tax plan in its form, you will see an expansion in S&P 500 earnings.
But are investors processing this?
I think they already did. We saw a nice little ramp up here. Probably got ahead of itself because we still have to vote on the Congress still has to get the budget through, and we'll probably know more by Thanksgiving. Well, whether this is a reality or not. But I do think Kostin's point is spot on that you will see an expansion, particularly in domestic firms such as the small caps. There is definitely reason to celebrate, unless you're in one of the blue states, if this gets through.
Well, because the market sort of rallied after the election on the expectations of tax reform, and then everyone realized, okay, maybe this is not going to happen so soon, and now we get perhaps the most details we've ever received on tax reform, and we got a grind higher, but no major market reaction. David, help us out.
I think it's a two-edged sword. I personally, I think we should have tax reform. It should happen, and this is probably a great start. Whatever the final bill comes out to be, if they even get anything done, because that's heavens knows with our Congress and the president fighting all the time. But that being said, I think it will be a boost to the economy, but also you're talking about increasing the debt. There's going to be less revenue to the government, and we're at a stage of our economy, or we're at a stage of our debt. Whether it's governmental debt, whether it's corporate debt, or whether it's personal debt, we are at such extended levels that we haven't been before. So when Ronald Reagan did this back in the 80s, the government wasn't nearly in this kind of debt, and then the debt started ballooning, and it's been ballooning since. Well, if you go to now, and you do it, let's say we pull another President Obama, where the debt, he was adding $1 trillion a year for a while there, during the recession period. Okay, if you do that again at these levels, what happens? I don't know. Do we become Japan, where the market has a big sell-off and you go into stagnation for 25 years?
Peter, do we get tax reform this year?
I think we get it, but I think
I
think he was overly, maybe not this year, but we'll make progress towards it. I think he's being very simplistic on what he's looking at in terms of tax reform. First, we have to look at what companies are already paying well below 20% marginal tax rate. Right? If this comes through, I think it's going to be hard to pay much below 20%, maybe get down to 18. So I think you're supposed to be looking at companies that are paying 8%, 10% marginal taxes. They probably actually lose on this, so he doesn't address that.
Well, there are losers.
Right.
No
You
doubt
start
about
talking
it.
about the interest rate deductibility. So the companies that issue debt, they get to deduct the interest as an expense. That's potentially going to get tabled in some way. They're going to limit that. That's going to hurt some companies. They talked about the repatriation, which again should help a lot of the tech companies. There's going to be a tax out of that. I don't think that money's coming back to the market. I think a lot of that's going to be to true up their balance sheets. And then finally, there was some talk about whether it was territorial, but overseas taxation, where you get a minimum tax going forward. So I think this is not going to be as good for large-scale corporates right now. And I would be going through my portfolio trying to get rid of some of the most efficient companies. I'd look for big domestic beneficiaries. And I do believe as this progresses, the big winner is going to be disposable income. So small to, weaker to middle-class consumers are probably going to see a little bit more money in their pocket. So I would track where they spend that money. I think those will be the beneficiaries.
Energy too. And a lot of energy firms are paying almost 40% net effective.
Yeah. So what are the winners and losers with repatriation?
Domestic firms and energy. I mean, that's truly what I believe. You guys know I like energy. I liked energy for a while now. I'm still long Apache, still long Schlumberger. Got myself in at the bottom here with Sanchez Energy. Let's see how that goes. And I got long Valero in response to the storm in Houston.
Yeah.
All four of them are moving in the right direction right now. I'm actually in the green in Apache because I started too early in that one, which I can't believe. But it's a space I want to be long.
Yeah, and income seekers, we recommend the MLPs. We really like that. And we like high yield again for the last few weeks, because I think they are big beneficiaries on the income side from this tax reform.
When Cohn came out and actually did the presentation, he said the extra $1,000 in your pocket you could use to buy a car or redo a kitchen. So there's probably some stocks we could think about there.
If we ever get it, maybe that
kitchen
goes,
stocks.
Well, maybe it just goes to Amazon.
Right.
Sarge, GE though has a lot of cash overseas.
GE for a non-tech has about, I forget what the number is, but it's something gigantic that they have over there. GE's actually in a sweet spot here because they got rid of Jeffrey Immelt. So now they have this guy Flannery. I don't know if he's any good, but he's not Jeffrey Immelt. So that gives him you an immediate floor, a bid somewhere.
Worst performing Dow stock this year.
Probably for the last 15 years. I mean, go back to 2000. I mean, we had a market run, which is epic, and GE's gone sideways for 15 years. So this is, and it's also a dividend stock. You like a dividend? It's a dividend stock. So you got a new CEO. He's trying to streamline the company. You're going to get paid a dividend. If you don't make money, you'll at least get some cash in your account from that.
Apple, Cisco, Microsoft are also holding trillions of dollars in cash overseas. Is that a reason to buy a stock? I mean, you know, we see shares of Cisco, you know, recovering because this thought that, hey, maybe it will benefit from tax reform. So clearly some investors are adhering to that strategy.
Well, this administration hasn't poo-pooed the idea of companies repatriating stock and then using it for stock buybacks. And I think that was certainly something that the market was a little bit anxious about, that they would be told they couldn't use it for that. But certainly if they're going to bring the money back and they're going to start buying their stock back, then you'd expect it to
I think
rise.
they've already been, I think people are going to have to be very careful on that thesis, because I just worked up some numbers on Oracle, for an example. And 4 years ago, they had 15 billion of debt and 30 billion of cash. They currently have 65 billion of cash and about 55 billion of debt. So they have been raising, they've basically
It's already here.
It's already here.
Yeah.
They've been borrowing against this. So I think, say that 65 billion, if it comes over, say 50 of it was overseas, you get 10% rate, 5 billion. They're going to have to manage that balance sheet. If they use a big chunk of that, their credit rating will start to deteriorate. Their growth prospects may be questionable. So just take a look at these stocks, I think, before you get too excited. If they've been borrowing a lot of money against their cash, if their shares have already been coming down, a lot of this repatriation's been planned for and is already accounted for. So I would be a little bit cautious, especially if some of these other things come in that could be detrimental on the big tech.
So you're saying they'd buy back their debt?
I think they're going to certainly slow down the issuance of the debt and use that money to pay debt as it comes due. Or I really like buying some of the long-dated debt because they may choose to buy some of that long-dated debt back, especially some of it, say, 90 cents on the dollar because yields have moved. They can book a profit if they need profit. They may have some high dollar price debt. I think they will spend a bunch of time rehabilitating their balance sheets rather than just buying back stock and getting big dividends.
And
Only for about what?
we know a lot of tech companies are buying corporate bonds, right? They're starting their own trading desk because they don't know what to do with all this money. That's something to keep in mind as well. I want to ask everyone, if we don't get tax reform this year, and there's no real indication that we're going to get it, you know, in the first quarter of next year, does the market still grind higher? Are there enough other fundamentals to push us higher by the end of the year?
If the budget isn't passed in a timely fashion, and then the tax reform is pushed out, and the Fed stays on trajectory for a December rate hike, well then my projections for the fourth quarter will actually have to be scaled back somewhat. Then we'll have to change our book a little bit, we'll have to adjust. Hopefully not too bad, but that'll give you your 5% correction, Peter.
David, if we don't get tax reform this year?
I think it's a very iffy proposition if we will get tax reform this year, just the way the government has been functioning lately. So if we don't get tax reform this year, I think it will be significant. I think it's been priced into the market, I believe, since after Trump got elected. And so, like we said before, they came out with a plan, a little euphoric bump, a little bit, not huge, but towards the end of last month. If these things start going sideways, one more failure on a major thing, it's not a positive. And so even if it gets kicked into next year, depending on the rhetoric surrounding that, depending on the Chuck Schumers and the Nancy Pelosi's of the world and what they're actually saying, the rhetoric around it, if it turns into a really nasty fight, I think we could be in for it's an issue, it's a problem.
All right, we'll obviously be watching tax reform in the coming months, but something else that happened since our last roundtable, Goldman Sachs weighing a move into Bitcoin, maybe trading Bitcoin amid interest from institutional investors. Does this just show maybe how desperate Goldman is to revive its trading business? Because you had JP Morgan come out and say, Jamie Dimon, and say Bitcoin is a fraud. So how do you have his arch rival potentially moving into Bitcoin? Peter?
I think that you're right to be looking at Bitcoin. I think 2 months ago when we did a roundtable, one of the guests here mentioned that their firm is constantly being asked about Bitcoin. So I think it's become something every high net worth, family office, RIA is looking at. Should they have a percentage in this? So I think it's rational. First, we've got some volatility. The rest of the markets have no volatility, little trading volume. There's a lot of people looking at Bitcoin. They're seeing the returns. They want to understand it better. There's actually a dearth of information about it, especially from credible sources. I think, if you go onto Twitter and to me, Bitcoin sources tend to be either those who really, really love it or really, really hate it, with little being done to try and explain what's going on, why you might want to be long at a period of time, why you might want to be short, what these different ICOs make. So I think that will actually be a growth area across Wall Street, just because that is what people care about and want to know and understand.
But at the same time, I think you need a relaxation of the Volcker rule to get into Bitcoin trading. If you're going to actually start making markets in it, then you're going to have to take some risk.
Right.
And this is a very volatile product.
Do you think Volcker would impact Bitcoin?
Well, if you're going to be taking assets onto your balance sheet and taking risks so you can become a market maker, absolutely. And I think that that would be the next step. Obviously, I think there's a lot of folks want to get into Bitcoin, but when you're dealing in institutional size numbers, is the volume there on a daily basis?
Yeah.
Remember when Ethereum dropped down to about 10 cents and it had this big collapse on a flash day? I think it was $12.5 million was sold to make it push down that low. $12.5 million is a de minimis trade when it comes in the currency markets. So for you to be able to trade big size, I think you need to get some bigger players in there. And I don't think we're there yet, but certainly you need to talk about Bitcoin, because otherwise people are going to say you're not it's like the .com craze, right? If you add a .com to your name, then everyone's like, well, that's a stock I should own. If you start talking about Bitcoin, it's the same way.
But that's also a worrisome view if it's so shallow like that.
But I think you have to look at it in a shallow way, because I firmly believe that if a JP Morgan was to come out with their own cryptocurrency, or if the Fed was, or the Chinese were, I think people would flock to that and would sort of forget about all of the work that has been done by Bitcoin, Ethereum, and others.
Well, Japan, they're starting, a consortium of Japanese banks are starting their own cryptocurrency, J-Coin. It has the support, reportedly, of the Bank of Japan. I mean, how important is that for a central bank to kind of have the backing?
That's really
Doug and I were
important because they
talking
regulate things.
Yeah.
Doug and I were talking. It's not just happening in Japan. There's a consortium of 13 banks between Europe and the United States that are doing the same thing, and they're going to come out with their Bitcoin sometime in 2018. They're trying to get it out, sooner rather than later, but it's probably going to be late third quarter, or fourth quarter of 2018. When you start getting major banks like that, and to say, okay, we're going to come out with our own cryptocurrency. Bitcoin and Ethereum have laid the groundwork. I'm not sure they'll be around. I'm not sure, I'm no expert at it, so I don't want to say. But what I would say is, when you got Christine Lagarde talking to the Bank of International Settlements and the IMF saying, okay, you better take cryptocurrency seriously, you're going to take them seriously. Major banks around the world.
No one wants to be accused of sort of, missing the ball here.
We talked about this earlier, like McDonald's, formed by two brothers. They had a great idea. Maybe Bitcoin's McDonald's, and then someone comes along and says, you know what, I'm going to take this and I'm going to make it much bigger.
Right.
And I think to do that, you need to have that in institutional size, and you need to have sort of regulatory approval. And I think that you have to be a government to do that.
And the new one might avoid. I think one big concern everyone has is how much of this initial wave was black market, illicit type money finding its way into the creation of this. So maybe you start something new. It doesn't have that legacy. It's a very tricky product. I think you've got to be very careful. I currently liked it. I liked how we bounced after the China crackdown. But we all have to be really aware that right now, I think someone told me the cost of mining Bitcoin is about $250. So at $3,000, it's hugely profitable. You know how easy it is for miners to go and buy a little bit of Bitcoin, create stability. And any rule that we have that's in stocks that are sometimes hard enough to enforce are non-existent in Bitcoin. So I think you have to be extremely cautious, extremely skeptical that someone's out to get you.
It's just kind of funny that they use the word mining for Bitcoin.
Well, you invest in the miners, right? This is going to create volume. Yes, Goldman is desperate, by the way. They've been underperforming their peers for quarters.
But when people at home see Goldman potentially getting into Bitcoin, I mean, what is your advice?
You're going to create volume there. I'm not going to go invest in Bitcoin, but I am going to invest in AMD and get back into NVIDIA and those kinds of stocks, because they're the ones that are going to make money from mining the blockchain. That's where you go. If you want to go, I mean, yes, is there risk in a stock, $180 stock like NVIDIA? Of course there is, but it's a lot less risky than blockchain.
But NVIDIA has many other areas than cryptocurrency, right?
Artificial
intelligence.
Stock like NVIDIA is everywhere, and Huang's done a fantastic job of putting that firm in every relevant technology business. Like I said, I'm out of it right now. Doesn't mean I don't like the stock. It's a good stock, it's a good business, and there are others like it that maybe have a chance to move a little higher.
Yeah.
That's where you go. You don't go into the cryptocurrency, at least not yet, in my opinion.
David, I mean, how do you grapple with investors who are weighing an investment in Bitcoin versus gold? What do you tell them?
It's interesting on two tracks. What they're looking for is they're looking for an alternative. So if people, investors, whatever, are looking for alternatives to a currency, cryptocurrencies are the new alternative, and there's a reason they're looking for that alternative. They're trying to, they're trying to trade cheaper. They're trying to avoid banks and bank charges. There's all sorts of legitimate reasons, not just hiding money necessarily from taxes or nefarious purposes for cryptocurrencies. So on that regard, cryptocurrencies, there is a real basis for them. The flip side is gold has been money for 5,000 years. Right. So but so is a dollar is basically a cryptocurrency right now. Yes, we have cash, and it's another interesting point. What's happening in Puerto Rico? So you have national currencies, the euro, the dollar, the yuan, that are all virtually cryptocurrencies right now. They're going to need adjustments or whatever to get to that cryptocurrency stage. But at the same time, they need to be backed by something different. There has to be something solid behind them so that people can understand and so that abuses can't be made.
My concern, though, is people watching and say, oh, Goldman Sachs is getting in, must mean I should get in too. But if Goldman's bet goes sour, they're going to be fine. Their institutional clients will be fine.
Goldman's
but if someone's...
Right.
Goldman didn't say that they were doing it. They said they were thinking about getting into it.
But the thought of getting into it could prompt average investors to jump in as well, just for that reason alone. And that's I'm trying to drive that point.
The average guy is
there's there's a bunch of people looking to get ETFs approved. So I think that's the other thing that is very supportive for the crypto from a trading standpoint is the number of ways people will be able to buy into this without having to get a wallet is increasing, and that will make it much easier. I think if we get an ETF out there, that will really help spike demand for Bitcoin, because all of a sudden someone who doesn't have access, isn't comfortable doing it the current methodologies, may feel very comfortable that they can go and click on buy on an ETF symbol. So it's occurring and it's becoming mainstream across the board. So I think Goldman's rightly reacting to that.
There has to be utility for it, though. Also, you can't just do it on a trading basis only. Dollar has utility. That's what we were talking about. The Chinese and the Russians are going away from dollar versus the petrodollar, and they're trying to do something different. The dollar has utility. If you have a cryptocurrency, it has to have a utility. There has to be utility.
The majority of dollar trading isn't done on a speculative basis.
Right.
It's done by corporates. It's done by governments. And it's moving money from one center to the other. Cryptocurrencies is primarily speculative right now.
Right. So you have to have that utility to make it worthwhile. You need a marketplace.
If Goldman goes ahead with this, and if they make money, next year when we do this interview, there'll be 25 firms pushing Bitcoin, and then the regular investor will have exposure.
Yeah, by then they'll be pushing their own cryptocurrency.
Good for them.
Banks are coming up with their own.
For at least exploring it. We'll see how it plays out. Obviously, it's trading strategies for October, and we are coming up on the 30th anniversary of Black Monday, October 19th, 1987. The Dow fell 508 points. Sarge, remind us the factors that were driving those declines at that time.
Well, valuations were obviously stretched, and valuations did matter more at that time. Dave. People had bought insurance against the market. Futures trading, options trading, these things were a lot closer to their infancy, to the developed stage of those markets where they are now. That only exacerbating when the selling started rolling on. I was a trading assistant on the floor for the Pershing division of Donaldson, Lufkin, Gen Red at the time. I worked right under the podium. And I will tell you, in my 34-year career on Wall Street, I have never seen the pandemonium that I saw that day.
And you were on the floor,
I was on the trading floor.
In other terrible times, right? 9/11?
Right. The day we came back after 9/11 is probably the closest to that in terms of pandemonium, because of our sentiment coming back, working in smoke conditions, everybody having to bid and offer verbally with masks over their faces. But just the sheer panic, the phones that wouldn't stop, all week long that week, we had to be in by 4:30 in the morning, and we probably didn't get out till about 11:30. I just remember them wheeling carts of sandwiches onto the floor because nobody could leave. I called my fiance, who I'm now married to for 3 decades, and I said, "I'll see you when I see you. I don't know when I'm getting out of here." And I remember what blew me away that day was as we left late that night, I tried to leave the exchange, and there were so many reporters outside the exchange sticking microphones in our faces that we couldn't even get to the subway. It was really an incredible time.
David, take us back to October 19th, 1987.
So at that point in time, I was actually I was a broker on the floor and a member, and I had gotten my membership in early September, so I'd only been there for a month and a half or whatever doing the job. And I'm from Chicago. I had come from Chicago, so I could barely understand these guys and their accents. And I was running past guys like Sarge. Sarge was at the bottom of and I was running back. But My most vivid memory is my boss at the time was a guy named Dick Ledoux, who's from Long Island. He's a Brooklyn kid.
I remember him.
Brooklyn kid. And he said he would hand me a stack of orders, and he would say, go do these. Well, do these was sell. There were no buys. There was just sell. And so I would run out to the specialist, and I would say, give me a bid in GE, mini mines, whatever it was. And as we were doing it, they would show me a bid down. If they showed me a bid down a quarter, it was sold. If they showed me a bid down 50 cents, I went, sold. If they showed me a bid down $1, I wouldn't do it. And these were for, anywhere from 10 to 50,000 shares, something like that. It wasn't huge size at the time. I ran back up to the booth and I said, Dick, I sold 10 out of 12. Here's the 2 I can't sell them. He goes, what do you mean you can't sell them? I go, I can't sell them. There's, you bid me down $1. I'm not going to sell it down $1. I heard some words I'd never heard before.
Do you know that
even as an Army Ranger, we just didn't use those words.
Do you know that 1.7% of New York Exchange composite volume that day was in my handwriting?
So we were
in
hitting
a museum somewhere?
It should be.
So it's your fault.
I guess the point I'm making is
They were
that
probably all buys if it was Sarge.
At that point in time, there were specialists that were making markets, and those markets were being made, and guys like me were saying, oh, that's not a good market, I'm not going to do it. In today's environment, those guys making markets don't exist. It's all algorithmic, and those guys down on the floor, they can turn those off quicker than, and when you say make me a bid, they're going to say no. I would also like to point out that in 1987, it was a 3 or 4 day lead up. The week before, the markets were extremely high levels. The week before, we'd had a couple of sell-offs of 90 and 100 points, which was very large at the time. And then Monday, it was 500 points, which was the 20-point. So it led up to it. So these things it's not just instantaneous and happen in a day. These things are cumulative and they happen over time.
I was looking at some of the numbers. The Dow is up 1,200% since Black Monday. So that just goes to show you can't panic during one of these crashes.
So
unless you're
not to
Nakai.
sell.
I think it was up 10% Black Tuesday, right? I mean, it came back a long way the next day.
But see, this is to my earlier point, though, Scott. You said the market's up 1,200 since then. Great, I get it. The Japanese are not up. They're down 50% since 1989. So we have been conditioned to say it's going to go up because we've been injecting liquidity. Every time there's a market dislocation, we've been injecting liquidity. If at some point in time those liquidity injections don't work, that's an issue. And that goes to my old boss, Dave Shields, and I wish you guys would get him on before talk about the oil crash. There's a difference between a market panic and a systemic collapse. A market panic occurred in 1987. They stopped a systemic collapse. The systemic collapse was very, very close. A market panic occurred in 2008. They stopped the systemic collapse because of the injections they did. If that systemic collapse occurs, that changes everything. And that's why they do these liquidity injections. That's why they had TARP. That's why they had QE. These are things that have never been done before.
Yeah.
And
so in our final 2 minutes, one thing we're working on here at TheStreet is getting millennials into the market, teaching them about money. Sarge, what's one investing tip you'd give your kids right now?
Oh, probably the best thing for a young guy or gal to learn is to never jump in with both feet. When you initiate a position, you initiate with 1/5 or 1/6 of that position. You want to own 200 shares, start out with 40 shares.
David?
I agree with you. Do your research. Don't just follow the crowd. Don't just go along. Do some research and be innovative. But also, learn from the masters. J.P. Morgan said, gold is money. Everything else is just credit.
Ooh, there's a shameless plug for gold. Peter?
I think you're supposed to take time to formulate your opinion. What do you think of the economy? What do you think is out there? That lets you take a look at investments with a right framework. And from there, I think you really have to be careful about buying what you know and love just because it's a great product. It may not be a great valuation.
Like Snap, don't buy Snap.
Right, I think that's exactly right. You've got to watch and separate great products, great companies, great managers from great valuations, and that's where a lot of trouble comes, I think, for new investors. They see a company that's great, they buy it and wonder why the stock's down as well, because everyone saw it and they couldn't meet the expectations.
Douglas?
I'm a contrarian. I always think that you shouldn't, that just because your friends are talking about it, that's probably something I wouldn't buy. Right. So I like to look around, I like to invest in things that I know, that I enjoy, that I like, that I understand, not just that specific thing, but the industry. But also, just because your buddies are doing it, Don't follow the crowd.
But what about this notion of compounding interest, starting young? I did a book a couple of years ago, More Money Please, about millennial money, and this was the main point, is you have to start young because it doesn't really matter what the markets do. You have time on your side. Speak to the power of compounding interest.
Well, that's something also to teach the young folks is diversification. Yes, you should not be managing all of your money. Some of your money should be somewhere else, where somebody with a professional background is putting this in an area that would be safe and would compound interest.
Well, compounding interest only works when there's interest. So
Yes.
we talked about compounding
Thank you.
interest when there's a
Thank you.
5% interest rate, 6, 7, 8% interest rate.
10%, right.
When
Yeah,
it's at
but
0, it's tough to compound.
But if you put money in an ETF over 30 years, I mean,
What depends on the ETF.
there's
It's an
compounding
ETF
right.
of.
Yeah,
in
that's,
But if
index
you-
fund of the S&P 500.
But these days, if you put money in your bank account and you get
no.
0.03%.
Well, I'm talking about investing the money in compounding interest.
I
It's
think
tough.
diversification is the key. I mean, you want to make sure you're well represented across a broad spectrum of investments. You want to have debt, not your personal debt, but you want to own bonds, or at least some exposure to bonds. You want to own equities. You want to own gold with Davey here, and you want to have some money in cash in case the boiler goes.
All right. It's all good advice. We'll be watching it all, and we'll see you guys back here in a couple weeks. And thanks everyone at home for watching Trading Strategies for October.